press the bell icon on the YouTube app and never miss another update.
PQR Limited's accounting year ends on 31st March. The company made a loss of Rs 2 lakhs for the year ending 31st March 2015. For the year ending 31st March 16, 31st March 17, it made profits of Rs 1 lakh and Rs 1,20,000 respectively. It is assumed that the loss of a year can be carried forward for 8 years and tax rate is 40%. By the end of 31st March 15, the company feels that there will be sufficient taxable income in the future years against which the carry forward loss can be set off. There is no difference between taxable income and accounting income except that the carry forward loss is allowed in the years 2016 and 17 for tax purpose. Prepare a statement of profit and loss for the year ending 2015, 2016 and 2017. We are supposed to prepare a statement of P&L. If you are preparing a profit and loss statement, then in profit and loss statement we have to show tax expense. Tax expense is the sum total of current tax and deferred tax. So this question is not limited only to deferred taxes. We will also have to calculate current tax over here. And that is going to be our first working. We will calculate what is the amount of the current tax. So please give the heading, computation of current tax. You will say computation of current tax. Let's show our calculation. $14, $15, $15, $16, $16, $17. Current tax means the amount of tax that we are going to pay. So we start with gross taxable income. For 31st March 15, they are saying that the company has made a loss. So we have a taxation loss. That means the gross taxable income is 0. The next 2 years we are expecting 1 lakh, 1,20,000. Now we are having taxation loss. This taxation loss can be carried forward and set off against taxable income in future. In the first year you have a taxation loss of 2 lakhs. So 2 lakhs will be carried forward. In the first year I don't have to do any set off. But 2 lakhs is carried forward. So 1 lakh I set off and in the first year and the balance 1 lakh in the next year. So this will help me to reduce my taxable income. So this gives you the net taxable income. 0, 0 and 20,000. I will apply the tax rate. %40. So this gives us the first part of the tax expense, current tax. So in the year 2016-17, we will pay a tax of 8,000. The first 2 years we are not going to pay any tax at all. So that is my current tax. If you are still writing, you can pause the video and complete it. Since the question is to prepare the P&L, in the P&L I will have to show tax expense. Tax expense we know is current tax plus deferred tax. I am ready with the current tax. My next working should be for deferred tax. Now if you see here, they are saying towards the end of the question, there is no difference between taxable income and accounting income. So taxable income and accounting income is exactly the same. If both are same, that means there are no timing differences. And if there are no timing differences, there will be no deferred taxes. However, you are having taxation loss. Just see this. Taxation loss is carried forward. And as the taxation loss was carried forward, we saved tax. So taxation loss is resulting into deferred tax asset. So I will have to calculate deferred taxes on the taxation loss. Now if you remember, there is one episode dedicated to conditions to be fulfilled for recognition of DTA. Two items, unabsorbed depreciation and taxation loss. You can recognize deferred tax asset provided you are virtually certain that there shall be sufficient taxable income in future. Virtually certain means you should be 100% sure. If you are not 100% confident that there shall be taxable income in future, you cannot recognize a DTA on taxation loss. If you see this question carefully, there is certain use of language which will help us. They are saying, see, after the tax rate of 40%, they are saying, by the end of 31st March 2015, the company feels that there will be sufficient taxable income in the future years against which carry forward loss can be set off. So the question is clearly mentioning that, see, we are confident that there will be taxable income in future, so I can recognize the DTA. By chance, if the question was something in this way, that the company is not sure, or if they use the word the company is reasonably certain, I will not recognize DTA on taxation loss. I can recognize DTA on taxation loss only if the company is virtually certain. They say that the company is confident that there will be sufficient taxable income in future. That is the reason we are going to recognize DTA. Let's show the calculation. Please give the heading. Computation of deferred taxes. Computation of deferred taxes. And again prepare this table. Particulars and the 3 years. Hope you are ready with it. So we say here A. Taxation loss. Taxation loss carried forward. And here we will say taxation loss set off. So we know that taxation loss carried forward is 2 lakhs. And the taxation loss set off is 1 lakh in each of the years. This will give you timing difference. This will give you cumulative timing difference. To this 2 lakhs, add this negative 1 lakh. And to this 1 lakh, add this negative 1 lakh. Tax rate. Because of taxation loss, you will save tax in future. So this is a very simple case. I have to recognize deferred tax asset, DTA. It's the closing balance. DTA for the year. DTA recognized. DTA reversed. So I'm ready with the current tax, I'm ready with the deferred tax. We can now prepare the P&L. If you are still solving, just pause the video first and complete it. Let's do the main question now. We say statement of profit and loss. Yes, we said profit before tax. They have themselves given that the accounting income and the taxable income both are the same. So this will be 2 lakhs, 1 lakh, 1,20,000. We say less tax expense, right? This is how it is presented in your P&L, tax expense. We'll say A, current tax. We'll say B, deferred tax. We know the current tax is 8,000 for the last year, so you put 8,000 over there. Now be careful with the deferred tax that we are supposed to put over here. If you'll see your working, we are showing 80,000. If you see the earlier working of deferred taxes, this is what we are having. This is DTA recognized, while this is DTA reversed, isn't it? This is what we are having in the earlier working. Now if you are saying I have recognized the DTA, that means your accounting entry will be, DTA is recognized, your accounting entry is deferred tax asset account debit to profit and loss account. P&L is getting credited. Now if the P&L is getting credited, then I will have to show this as negative over here, 80,000. See, the word used is tax expense. Expense means it should be debited to the P&L. So I am showing a debit item. but it is not a debit item. It is actually a credit item. That's the reason I'll have to write this as negative over here. DTA is getting reversed over here, right? My accounting entry here is DTA account debit to P&L. But when the DTA reverses, then my accounting entry will be profit and loss account debit to DTA. So now P&L will get debited. Debited means it's an expense. So this I will write as positive. This 40,000 also I'll write as positive. I hope you are comfortable with it. Tax expense, we are saying less tax expense. Expense means it should be something that is debited to the P&L. This is not debited to the P&L but credited. So I show as negative. This 40 and this 40 will be debited to the P&L. Similarly, 8,000 of current tax will be also debited to the P&L. Profit and loss account debit to current tax. That's the reason. It is also an expense. So this is how I will be showing it. Let's complete it now. This is what will give you profit after tax, your PAT. What do you say? PAT. You have negative 2 lakhs, right? Negative 2 lakhs minus minus. Understand? Negative 2 lakhs minus minus. It will get added. So 1 lakh 20. This will be simple. 1 lakh minus 40,000. So 60,000. And then 1 lakh 20 minus 48,000. 72,000.
Press the bell icon on the YouTube app and never miss another update.